Hi, everyone. This is Jason Burek of Wall Street for Main Street. Welcome back to another Wall Street for Main Street podcast interview. Today's special guest is a returning guest. Actually, he's my favorite guest. He is editor and publisher of the Gloom, Boom, and Doom Report. He's an excellent distressed asset investor over many different cycles. Dr. Marc Faber, thank you for joining me again.
Well, thank you very much for having me on your program. And thank you to your listeners for letting me speak my thoughts.
Well, I've enjoyed learning from you over the years, many years, and you've had a lot of good calls as a distressed asset investor too, being a contrarian. Although now I think it's very difficult being a contrarian now because everyone's chasing what short-term profits, what it's new marketing cycles with the AI bubble and all these things. It's just ridiculous.
Well, we've been through these ridiculous cycles on many occasions, especially here in Asia, where valuations occasionally get out of hand and then they readjust and then they become inexpensive again. And I think if I look at the world today, it reminds me of the period between 69 and 1974, when the market was driven to the high in January 1973 by very few stocks, the so-called Nifty 50. And it was also a period of accelerating inflation. And the inflation then went on until 1980, 81. So there are some similarities. And it creates also opportunities because some stocks are very cheap and some stocks are very expensive.
Yeah, I completely agree, especially small caps. I mean, there's been a lot of small caps that have just been babies thrown out with the bathwater. Some of these businesses are still making a lot of money, but then there's also small caps that were trying to use debt for growth and they can't raise any capital.
Yes, there's both.
So before we talk maybe about sectors you like, I want to get your thoughts, though, on the interest rates, because I know you've read the history of interest rates. We've talked about this in the past interviews, too. We're recording this interview, by the way, on Thursday, November 2nd, 2023. For our listeners, the dollar index is down a little bit, still high, relatively high at 106.12. In your opinion, Marc, what are the largest problems with rates much higher than 18 months ago for asset prices and the global economy?
Well, rising interest rates have the tendency to lower valuations. In other words, there is a PE, a price earnings contraction, that occurs when interest rates go up. But I'd just like to mention one point that is very important to understand. Interest rates are much higher today than 3 years ago. So first of all, people who have cash, who have assets, they may not suffer much from the higher interest rates. In fact, they may benefit. I'm a relatively liquid person. And 3 years ago, 2 years ago, on say $1 million, I got an interest of less than 1%. So the income was, say, on 0.5%. On $1,005,000. Now, on $1 million, I get 5%, 6% yield. So the income for me is between 50 and 60,000. And you multiply that to $1 billion. So it shows wealthy people who have no debts but are net cash, they actually benefit at the present time. Number two, it is true that interest rates have gone up a lot from the artificially low level that central banks created in the period 2018 to 2020, or already before, in Europe with the ECB having negative interest rates. But I'd like to point out that this environment of negative interest rates and artificially low interest rates was a pure manipulation by central banks that created artificially low interest rates. Interest rates should never have gone this low. They were at the lowest level in the history of mankind. I mean, as you said, I read the history of interest rates, and I use it like a Bible. I look up things. Never before have interest rates been this low. And now interest rates have shot up. But I'd just like to point out the following. In the year 1973-74, inflation was, say, around, 6-7%. And the Treasury bond yield was at over 9%. In fact, in July 74, it climbed to over 12%. Now you compare an inflation rate today, and we all know that the government doesn't tell us the right cost of living increases. They understate inflation. But let's say, we could say our cost of living are increasing by 5-6% per annum. In the 70s, at this level of inflation, interest rates on 10 years bonds were between 9 and 12%. Nowadays, they are at less than 5%. So although interest rates have gone up a lot, they're still relatively low compared to the previous history of interest rates and the previous history of inflation. And I have to say, when I look at market action, let's say we look at today's market, which is very strong. All stocks go up, the banks go up, the interest rate sensitive stocks like the real estate developers go up, housing stocks, and so forth. It's not an environment of tight liquidity. The market action, the VIX index, the volatility index, and also credit spreads of high yield bonds vis-a-vis treasuries would not suggest that we are in a tight money environment. We have still plenty of liquidity. And that's why my sense is that for the next 6 months, inflation can come down somewhat. But thereafter, it is likely that inflation will accelerate. And eventually, we may exceed the inflation peaks of 1981, when inflation was, let's say, around 15% per annum.
So you mentioned in the 70s, but didn't inflation, it came in waves, right? So Arthur Burns thought he had beaten inflation. He took the foot off the gas pedal on the interest rate hikes, right? And then Paul Volcker came in. The difference now is total debt levels throughout society. So you have the US national debt, it's over 33 trillion. I mean, can the US federal government even afford interest payments at 9%? Is there even demand for bonds at those levels, for US Treasury bonds at the current levels at 5%? I mean, if you're a foreign investor, I'm sure you talk to a lot of hedge funds and institutional investors. Do people really trust the US federal government consumer price index and say, am I being fairly compensated for a 30-year treasury at what, under 5% with the inflation rate in the US?
I don't think that people think, or investors think, that they are adequately compensated for a 30-year bond at less than 5%. I think the risk is very high that these bond prices will go low. In other words, interest rates higher over time. However, for the next 6 months, the trader, the hedge fund manager, and the investor, he may say, okay, the economy is, in my opinion, already in recession, but the other investors, they think it's going into recession. Therefore, the Fed will not increase rates much more, and therefore interest rates over the next 6 months could come down somewhat. And so the 30-year bond would rally. That is kind of the general thinking that prevails at the present time on Wall Street. And this thinking of interest rates not going much higher has also helped like precious metals rally. But my view is we have to distinguish between the short term and the long term. You understand, in the 70s, we had the first wave of inflation, which peaked out around 1969. And thereafter, we had a period of disinflation. We still had inflation, But until 1972, the rate of inflation came down. And then we had the second wave of inflation, 1972 to 1974. And then we had a period when inflation slowed down between 74, the summer of 74, and 1976. And then the third wave brought us to over 15% inflation in 1980-81. And then we had a period of essentially 40 years of disinflation, 1981 to 2020. Now, it is true that Burns made several mistakes, but actually, to be fair to him, he's a brilliant intellect, and he was aware that interest rates were frequently not high enough. In other words, they were negative in real terms, and therefore inflation accelerated. My view would be that today, the level of interest rates, although much higher than a year ago and 2 years ago, is still too low to really combat inflation. But equally, with the level of debts that we have on the government level, the Fed and the Treasury have limited options. They could default on the debt. This is a possibility. Or they could increase taxation massively, or they can print money. The printing of money has in history for every society been the easiest to do and the least painful or recognizable painful. And I can tell you, you can go to Istanbul or to Buenos Aires, and you have inflation rates of 100% in these countries, and everything looks more or less normal. You know, the markets are open and the traffic is there. I mean, it's just that the inflation can accelerate very slowly, and people get higher salaries, but in real terms, the salaries go down as they have in the last few years, in real terms. In real terms, meaning inflation adjusted.
Well, isn't there also black market economies in their local economies there? They want to use dollars. They don't want to use the local currency. But if you go and eat at a restaurant in those cities, then the menu price could change very, very often. It's not stable pricing then.
No, but it is true, as you say, let's say when it comes to property prices, if you want to buy a condo or a house, the house will be sold in general in dollar terms.
So you mentioned that rates need to go higher, but I would argue that it's a lot different now because of total debt levels. It's not just government debt. I mean, corporate debt has doubled. It was the central bank policies of artificially cheap rates. I mean, the European Central Bank with the negative interest rate policy. I know you've read history of interest rates. Have we ever seen negative interest rates before? But when interest rates go up because of all that debt that was taken out at either artificial near zero or negative rates, once that debt starts to normalize, basically you have all these zombie companies and companies that shouldn't be alive that were kept alive for years.
Yes. So what is your argument against me? I said to you,
I'm just saying that
given the high level of debts, it's much easier for the government, the Treasury and the Fed and the government to print money than not to print money.
Oh, I'm in agreement. I'm just saying that
what are you arguing against me?
Oh, I'm not arguing against you. I'm just saying that society can't handle, it's not just government debt, it's society can't handle interest rates at these levels because people were fooled by the governments and the central banks to take out more debt.
No, they can handle it because for some people, the higher level of interest rates is beneficial. And the crucial issue, you asked me, when in history were interest rates negative in real terms? Well, on many occasions in history, interest rates were negative in real terms because the rate of inflation was higher than the level of interest rates. But never in history did a central bank that basically should be responsible for a sound monetary system, never before in history did the central bank peg interest rates at the negative level, as the ECB did, and the Swiss National Bank. And, in Holland, for instance, you could get mortgages at a negative interest rate. In other words, you were paid to buy a house. So this was a very artificially type of environment. But it was discussed in the economic literature before by a nutcase called Silvio Gesell. And he came from Bavaria, but he settled in Switzerland because we have a very free-thinking system in Switzerland, where the different opinions are, generally speaking, tolerated. But I want to make this clear. Inflation will likely accelerate in economies that are over-leveraged. In other words, in economies that have a high level of debt, because you can repudiate debts. In other words, you can default on the debt. But given the financial system, say in the US, we have pension funds. So if I'm the government and I default on the debt, what happens to all the pension funds? You understand? The pensioners, and some are old policemen, the veteran, and some are veteran military. They will go mad, because if the pension fund has defaults on its treasury bonds, then the payments to the pensioners will go down, and then there will be a rebellion. I tell you.
Well, the pension funds were investing in private equity at the top, commercial real estate at the top. I mean, I was looking at press releases for CalPERS and a lot of these other pension funds. They took out leverage in 2018, 2019. CalPERS did, for private equity investments in commercial real estate. So they were buying with leverage at the top. So I think there's a lot of losses, like you said, from pension funds coming.
Yes, but I agree with you. But the pension funds, it will be difficult for the government to default on the debt. That's what I'm trying to explain.
Oh,
it is also next to impossible to increase taxation sufficiently to cover the deficit. So the only way to cover the deficit over time is to print money.
So the dishonest way of default. So the long term, the dishonest, they're printing in nominal value then to pay off their unfunded obligations or bailouts. Because didn't the United Kingdom 12 months ago, they had a pension fund bailout too that was secret?
Yes, I would say to this is nothing new. Governments have always been dishonest. They portray the private sector to be dishonest and the entrepreneur to be cheaters and cutting corners. But the worst offenders of human rights, the worst offenders of the law, of jurisdiction, are government officials, because government officials very, very seldom get punished. Whereas in the private sector, if you commit a crime, usually you are convicted somewhere. But government officials, they can do the greatest blunders. And what do they get? They get the promotion. They become presidents of the United States or of Germany or of the ECB. It is a horrible trail of failures, and they are all rewarded by promotions. In the US, from the Federal Reserve to the Treasury Department, as an example, in the latest case.
Yeah, it's like an Ayn Rand novel.
Joke. From the Federal Reserve in San Francisco, that oversaw the greatest real estate bubble in 2006, 2007, and also the supervision of the state of Arizona, whole of California, and so forth, and Nevada. The president of the San Francisco Fed, Miss Yellen, became Fed chairman. And then, having failed completely to see that inflation was accelerating, because she never goes shopping, I guess. Her husband has to do that, or some valley.
Butler. Her
She's
butler.
then promoted to the Secretary of the Treasury. What a joke.
And she's worth over $10 million. And I think her husband's worth over $10 million. And they have like over half a dozen guaranteed government pensions too with their academic jobs. And then when she leaves the Treasury, she's going to get another consulting job with a hedge fund or BlackRock or something for a large amount of money too.
Yes, but I never complain about other people having money. I'm happy for them. But I'm just saying, when you compare that to ordinary citizens who have to work like hell to make ends meet, the working class. And you look at these people, it's really an elite at the top and totally contrary to the philosophy, the economic philosophy and the state philosophy of democracy, because democracy is based on free markets, or free markets come along with democracy and the capitalistic system. But this is a system of cronyism and of socialism and of interventions that are ill-timed and ill-conceived.
Yeah, there's a lot of criminals here in Washington, D.C. I call Washington, D.C. the District of Criminals, because there's a lot of white-collar criminals here with law degrees.
I'm glad you're thinking on this point the same way than I do.
Well, and yet you said you don't care if they're making more money. I mean, the problem is they're making money off the corruption and screwing over a lot of regular people and small business owners. And this is where all the problems are. They're bailing out their friends, and then they're printing all this extra money. I think they're printing trillions off balance sheet. I mean, the Inflation Reduction Act was Orwellian. It's not going to reduce inflation at all. I heard they put 70% of the Green New Deal spending, they snuck it in later.
Yeah, sure. This is the sad case of governments, and democracies have the tendency to make the bureaucracy actually worse than in a royal system. Because when the king really does stupid things, the people will chop off his head. But that doesn't happen in the bureaucracy that we have in democracies, because everybody says, "Oh, it's not my responsibility," or "I was told to do so." So everybody hides behind a curtain of consultants and of advisors and other departments, and nobody's ever responsible for anything.
But the problem with bureaucrats, Mark, is that they're unelected and they can't be fired. And a lot of them, like you said, like Jenny Ellen, a lot of them end up with promotions. So they're getting all these inflation increases and Cadillac benefits. They're trading on inside information on stocks or selling the info to hedge funds. And then there's no accountability because they can't be like a politician. They can't be voted out of office. And most of the time they're not fired.
Absolutely, that's the case. I'd say, in the private sector, someone has to be reasonably good to get a good job. And to climb within a company, he has to be somehow halfway smart. Although I see some presidents of companies that are not all that smart. But in government, you have universally pathological personalities and power-hungry morons. And the people that don't get jobs in the government and then go into NGOs. This is another creation of the government, essentially. The most stupid people are all in NGOs, and they interfere in the affairs of other countries and other people and so forth.
Yeah, there was the book Confessions of an Economic Hitman, and then there's a lot of foreign policy intervention, but then it's like all this foreign aid to Ukraine, and then they're talking about more to Israel, but that's all like kickbacks to the military-industrial complex to clear out their inventory of old, tanks and planes and guns and missiles and stuff.
Yes, but I'd like to now switch over to our investment world, what an investor should do. And my sense is, if I look at the long term, I mean, I'm not talking about tomorrow and the day after, but the long term, I think, is inevitable that central banks will sooner or later again ease, in other words, print money. And in this environment, I think the purchasing power of money lost. In other words, the purchasing power of money will go down. And in this environment, I think investors should have some gold and platinum and silver. And we've seen actually recently that gold shares or mining stocks can also underperform gold and physical silver, because stocks of mining companies are also paper. And there is a time when investors, because of the general uncertainty, may prefer to have physical precious metals under their bed or at home or in their garden or wherever. You understand? So I think we have to make a distinction between gold shares and certificates that are in paper form and physical.
Well, also the profit margins for a lot of these gold miners, the costs are going up. So the energy costs with higher interest rates, cost of capital. So their profit margins are not as good as people expected. We just saw that with First Majestic Silver earnings today. The profits are not as good as people expected with high gold and silver prices. And then also from what I hear, I mean, even though the metals prices for gold prices are relatively high, there's just not capital available for a lot of these juniors to go out and drill. Despite gold prices near 2000, there's almost no capital available for a lot of these companies to raise funds and either build a mine or go and drill.
Yes, there is no capital for good reasons. The miners are very good at lying, at telling stories. They've learned that by going to government conferences. So it is true that there is little confidence in financing new projects. And that's why stocks are down a lot. It's like the SPACs are down a lot. The meme stocks are all down a lot. It's just out of fashion. But I also want to point out, and I think this is very important for your listeners to understand. In the case of the invasion into Gaza, we've seen that the water can be switched off and the electricity can be switched off. And we've had also other examples in the world that the communication network gets switched off. Now you go to a department store or a store and you want to buy, I don't know, some groceries or what not, with a credit card. The credit card will not work. And you want to pay with Bitcoins. It won't work. But if you have physical gold and silver, not in kilobars, but in small denomination of 2 grams, 5 grams, 10 grams, and so forth, you can exchange that gold against, say, groceries. And this is something I would consider in my life very seriously. You know, if you live in the US and you have gold somewhere in Europe or in the UK or in Singapore, you may not have access to it in an emergency situation. So you should keep some gold with you. Ideally, you carry it around all the time.
Well, I mean, the crime here in major cities and metro areas in the United States is going up a lot. There's tons of shoplifting from a lot of stores. A lot of stores are closing. People are being robbed in broad daylight, held up at gunpoint. Here, I live right outside of Washington, D.C., and there's a record amount of carjackings. I mean, politicians, these rich politicians, literally are leaving their car running to go get coffee, and their cars are getting stolen the last couple of weeks.
They insure them before they get stolen.
Oh, you think it's some type of scam? Yeah, it wouldn't surprise me at this point. Do you think, though, that the plan for these governments and central banks, I know you talk about physical gold, but it seems that the plan for whether it's the Davos crowd, World Economic Forum, a lot of these central banks are already testing it, what central bank digital currencies, digital currencies, they want to track and tax all the transactions. So they don't want people paying in cash. They don't want people carrying around gold and silver and paying that, because that's a black market economy that was happening in the European Union for many years, and there wasn't enough tax receipts.
This is correct, what you just said, but I just want to point out, say, in the Roman Empire, also nowadays, The central government is not a popular government, nowhere. And the local people, say you live in a small village, and the government says everything is electronic and this and that, and they control you, then very soon in the small village, people will use something else as money. They can use cigarettes as money, as happens in prisoner camps, in concentration camps, and so forth. And forced labor camps, cigarettes become money because this you can exchange. And so a black market develops very quickly. And very quickly, people will sell their silver and gold. I mean, it's interesting. I live in Thailand, in the north. When the gold price goes up strongly and the economic condition is poor, people will not buy gold, but they sell it because they're not going to sell their cars. They're not going to sell their house, but they can liquidate some small coins of gold and pay their debts or pay for necessities. You understand? So, yes, the governments want to eliminate money that they cannot track. But at the same time, human history has been always based on small communities or larger ones occasionally that then print their own money or have their own means of exchange. And I think this will happen increasingly.
Yeah, I'd like to see that more freedom, but unfortunately, the people in power, the governments and central banks, it's looking like they want even more control. Now, I've seen,
but the people are not so totally stupid. Certainly, they're not as stupid as the central bankers and the government officials. And they can see behind the scam that the governments want to implement. And they will take their precautions.
Well, yeah, especially people in emerging markets, because they've had to deal with this longer. I mean, if you live in Argentina, you know not to trust the Argentinian government managing the Argentinian peso.
Yeah.
So you know that you
specialists.
Well, you need dollars. They have a black market economy in dollars. They buy gold and silver. They have Bitcoin. I mean, they're doing whatever they can to get around the government system.
Correct.
I want to ask you.
And then I talked about depressed assets. I just also want to point out that if we look at the relative performance of emerging markets with the US stocks, we are now at the lowest in this ratio in as much as like 20, 30 years. And I think that we find some emerging markets that are cheap. I mean, 2 years ago, I recommended Turkish stocks. And then I got a lot of emails by people who said, are you crazy? The currency is bad and the government is bad. And so and I said, yes, that's all right and all correct. But the stocks were very depressed because of the devaluation of the currency. And then in 2022, Turkish stocks doubled. This year, an Iraqi fund, is up 90%. And my sense is at the present time, Latin America is quite inexpensive. Colombia, Argentina, Brazil. And the country in Asia that is very depressed is Sri Lanka and especially Pakistan. Pakistan is extremely depressed, especially compared to India. So, and also Hong Kong is very depressed. Chinese stocks, not all, but a lot of Chinese stocks are very cheap. So there are plenty of opportunities in my view. Now, do I buy heavily right now? Not necessarily, because I think the bear market is still in the early stages in the world. Do you understand? We haven't really had depressed sentiment and panic selling. And as I mentioned, the volatility index is low, and the spreads between high yield and treasuries is also low. So the signs are not yet there that we are near a panic bottom. But usually between this time, November and December, there is seasonal strength. especially in the third presidential year. So I think this rally may surprise some people and squeeze the shorts.
And unfortunately, I think there's going to be tax law selling for a lot of gold and silver miners too. So that's going to exacerbate the problem on top of the capital not being available.
Yes.
So I think we'll have a panic bottom probably in the gold and silver miners, and there'll be a good buying opportunity then in the next couple of quarters.
Yes, correct. I mean, I have gold shares, but the bulk of my precious metals allocation is in physical form.
So I want to ask you about comments by Jim Grant of Grant's Interest Rate Observer recently, and also Bill Fleckenstein, former hedge fund manager. They've talked about a long-term bond bear market, a multi-generational bond bear market. Do you think that that's where we're headed? Because I know we've had, a record bond bear market for the last 3 years, but do you think that it can last a lot longer than that?
Yes, of course, it can last. Usually, the inflation cycle and the interest rate cycle, some people call it the contrarian. These are long-term waves. We had rising interest rates 1942 to 1980, 81, then falling rates until 2020. So for 40 years, rates were falling, and we had a period of disinflation. My sense is that we are now in a period of inflation that will last 20, 30 years, and that interest rates will go and exceed the peak of interest rates in 1981, when the 10-year Treasury yielded over 15%.
Wouldn't the U.S. federal government not be able to pay interest payments on who's going to buy the treasuries then? Where's the demand for the treasuries going to come from then, Mark?
The pension funds, but you have to print money. This is why I'm trying to explain to you for the third time that money printing is almost a necessity in future, that they either have to default or tax the hell out of people or print money. And the money printing is the easiest way out, especially for dishonest people. That I want to stress. Completely dishonest people without any morals, like most central bankers are, will print money. That's why there are central banks in this world, to print money. This is their principal function.
Yeah, I totally agree. And covert bailouts. Do you think these losses, so these banks and pension funds and insurance companies, are they sitting on trillions of dollars of losses now on these treasury bonds?
Yes, but but that is correct. But they don't have to realize these losses, the banks. And let's say you look at today's market, the banks were very strong. Why? Because interest rates came off. But I think banks have other problems, and also this bond problem that is real, especially if interest rates continue to go up. That's why, for the fourth time, I now repeat, the system as it is structured requires money printing. Otherwise, it's going to collapse.
Yeah, it sounds like a Ponzi scheme, Mark, where credit and debt.
Of course, that we know already for a long time. That's why I suggest to people, I can't force them, because I'm a free market believer. I not believe in forcing people to do something like the socialists always force people to do. But my advice is that everybody needs to be his own central bank and to own physical precious metals.
So it sounds like what you described, the system is coming, this debt-based system, the amount of total debt, credit, interest rates, it's coming to an end, because all that's left is central banks just printing money, bailouts.
Yes.
Are we going to need another system?
I also tried to explain to you that the end can be a very long end. I mean, people said to me already 4 years ago, Turkey will collapse. Well, it hasn't collapsed yet. They just keep on printing money. And Argentina, the same. but the standards of living are going down in these countries because ordinary people, they get salary increases, but the salary increases are usually lower than the rate of inflation.
And that's why people are looking, they're doing their economic transactions outside of the local currency, and the elites are borrowing in the local debt, and their debts are getting inflated away.
In some cases, yes, or in most cases, but not always. But listen, I've essentially expressed my views, and I don't have much more to say.
Yeah, it's a really difficult environment right now, Mark. In terms of volatility, we could have a bear market for a while. So you're bullish? You're not really bullish on anything in the short term, then? You don't see any bull markets anywhere right now?
Well, I tried to make clear that I think that precious metals are reasonably attractive, and I also explained that some markets and some sectors are relatively low, whereas FANG and FANG-related stocks in America are relatively high. But in the 70s, the market had touched 1,000 briefly in 64, or close to 1,000. And then in 66, it pierced 1,000 on the Dow Jones. And in 73, it made a new high. And by 1982, 18 years after the 1964 high, we were below 800 on the Dow Jones. In other words, we didn't go up in the 70s in stocks. But inflation adjusted, we went down 70%. Inflation adjusted, okay? Mm-hmm. And I think if you look at inflation adjusted charts, a large number of stocks are, of course, way down. They're also way down in nominal terms, but more so in real terms. And I think for investors, the returns in the next few years will be disappointing. But equally, I tell people to put all your money on deposit with a bank is a huge risk. That I also have deposits because I think that interest rates at 5% on, say, 9 months deposits is relatively attractive. But I don't trust the banks.
Well, JP Morgan doesn't have to pay five. JP Morgan, so the too big to fail banks here, the 5 or 6 ones here in the US, they don't have to pay depositors that type of return. But the regional banks, like, it seems a lot of people are still pulling money out of the regional banks. The regional banks, I think, look like they're getting screwed over real bad.
Well, and there's a risk with the dollar also. There's a risk in everything. When I grew up, my grandparents always said you may have to save 10% of your income and put it in a bank. It's safe. Yes, in the 50s, a bank deposit, certainly in Switzerland, was safe. Nowadays, nothing is safe. Because if the government could lock up people and close down their small shops and businesses and create huge problems for the majority of society, they can also take away everything you have, believe me.
Oh, I totally agree. Yeah, it's white-collar criminals, and they change the rules all the time. They bail out their friends, or they're doing, I mean, the new stuff here in DC is the pump and dump on the green energy companies, the solar, wind, electric vehicles. All these companies are scams. They don't make any money. The shares go up on the government spending, on the contracts, and then the shares collapse, but the insiders already cashed out.
Well, they're worse than criminals, because criminals, if you go into criminal circles, they have actually a relatively high code of morals. You know, they honor their word, and they don't squeal on each other. The government officials is the worst class in society.
No argument from me on that. I've studied Roman history just like you, and the Washington, D.C. metro area, there's a lot of similarities there, unfortunately, towards the end of the Roman Empire.
Listen, I'm sorry I have to leave you because it's already quite late here in Chiang Mai.
I want to thank you so much for your time today, Mark. I think we got a lot out of here. So basically, then higher interest rates, more inflation, bankruptcies for private sector companies, and more rules changes and bailouts and lies from the government.
In the long run, as I said, in the short term, I think interest rates may come down somewhat.
And that may give the people in DC an excuse to spend more money.
Yes.